And you know, when you're looking at the green area, you're always watching the low price if it's into a new low, because that's a possible buying opportunity to buy into it, those low prints. If it's inside the previous swing, it's not going to be an opportunity to buy the lows because it's inside the previous swing. Gold is very much a liquidity hungry market because it's a skinny market. So it's desperate for liquidity. It's desperate to find some of that action. And it's always very, very important that you always keep an eye on where these low prices are, because as I said, it's always scooping the low prices. So you can see that when this price then scoops out another green zone here, and then it goes into those lows, you know that that's going to be an opportunity to buy in, and that's why the max switches off during that up candle, because it's obviously bought the lows again. And then we get another green low, and you can already recognize straight away that this is going to be doing exactly the same at exactly the same lows. You're going to be trying to work into those stories. And it's just that constant process of driving down into the new low prices to try and recognize the opportunity. Now, if you get into a low price and then it doubles back and it breaks north, that's going to be the markup now, isn't it? Because they didn't get the lows. They didn't get the liquidity. Now they've got a cross. So you start looking at that and saying, wait a second, this is going to be the fast break. And that was the fast break. You started to recognize that opportunity for that fast money move away from those low prices off of 1772s because it didn't get the liquidity lows. If it's not getting the liquidity lows, it's going to have to try and take it higher, isn't it? So it's quite an important aspect of when you see Max starting to do business. If Max starts to do business at higher prices, that's a bit of evidence. Well, you can see in the last two trades there that Max did business at slightly higher prices. Max did business originally here, and then you can see in this candle here, Max started to do business on this candle, which was the same price. Max is starting to cross. Max is starting to get excited about the possibility of this price going up from here. And obviously from that point onwards, we get this very, 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 very substantial rally away from those areas, 1772s to 1777s. And then when we come back into this area here, the disappointing thing is we don't get the lows because we know where the low is. There's the low price there. So when Max switches on, you know that that's going to be a buy trade all day and all night, 1774.90 break. We don't get the lows. So that becomes a momentum. So you know, because we don't get the lows, you know that that's going to be a big move north. Or at least it should be a big move north because they didn't get the liquidity, Paul. They didn't get the liquidity. Max did not get the bottom edge. Max did not get the liquidity Max was looking for. So the algorithms that are based around Max's basic faded design are going to cross into the spreads to get filled. And that's going to provide you with a very, very fast money move on gold. And that's what happened. You got a very fast money move on gold off of those low prints. You got a very fast money move, and that's now over $1,000 profit at that stage. Over $1,000 profit at that stage off of those low prints. And obviously that's the trade of the afternoon session so far is right there. It's a crazy good trade based on that type of storyline evolving. Max is looking for the liquidity. Max is hunting the liquidity. That's what Max does. But when Max doesn't get the liquidity, the cross is going to be the aggressive cross. It's going to start doing the business, and it's going to be a fast money move. So it's one of those things that you're always going to be looking for. You can see Max is switched on here. So what is Max going for? Max was going to be going for the liquidity again here. So we can start looking for those liquidity grabs on these types of trades, and we can check out to see whether there's an opportunity for us to do a bit of business against those elements. That's what we then go into our order flow to do. We go into our order flow charts to then look for those opportunities to grab a bit of business just there. Now that trade was at 81.3. It's just traded 81.8. It's done 81.9 now, so I've made myself a very, very quick $60. Did anybody join me? Anybody join me on that Max trade right there? Now, obviously, Max was switched on at the time, so I took the trade. And obviously that little trade there was enabled me to go into a stop at break even, and I've just been scratched. Fair enough, I've just been scratched out in that trade, but that's okay. It made $60 on the way up, and I was able to get a stop at break even dead easy. So it was a dead easy trade outcome, wasn't it? It was a really easy way to look at the way that the markets are forming into pockets of liquidity, into these kind of low prints. Now, if Max stays switched on and then switches off, Max is into a new low liquidity. Max is into a new low liquidity already, isn't it? It's already into those areas. So we start watching for those in your order flows. So when you go into your tape, what are you starting to look for? You're looking for trapped sellers. You're looking for buyers on the bid coming in back into the book on the bid side. You're watching for those elements. You're looking for any type of liquidity being trapped. As I said, a seller getting trapped into these low prints. And then you're going to start working into those ideas. You're going to start looking for those bottom edges, and obviously it's a liquidity grab, so it's probably not going to get marked up aggressively because it has grabbed the liquidity. So this is one of those trades that's more of a patient trade where you just wait. You kind of wait, because obviously if they've grabbed the liquidity, they haven't not grabbed the liquidity, if you know what I mean. The trades that where they don't grab the liquidity, the two trades that they didn't grab the liquidity, what happened to the two trades that they didn't grab liquidity on? Well, let's just go back to those earlier trades. Let's go back to those earlier trades so that we can look at the two trades where they didn't grab liquidity. And it becomes quite obvious how you start to look at dealing in these areas. Go back to the four trades that we had before, or rather the five trades we had before. This trade here grabbed liquidity. This trade here grabbed liquidity. This trade here grabbed liquidity. So those two trades grabbed liquidity. Look at what happened to the trade outcomes. The trade got capped. The trade got capped. And the trade got capped, didn't they? Now, why would you cap a trade if you're grabbing liquidity? Why would you do that? Well, at its core, it's very simple, isn't it? At its core, it's very simple, because if there's enough sellers still coming in, why would you want to stop it? If there's enough sellers still coming in, why would you want to stop the selling? So in other words, when you see there's a lot of selling and it grabs liquidity, why would you want to stop the price from dropping down? So when you think about it from a theoretical point of view, it makes perfect sense. If the price is doing this, and the price is doing this, this idea of letting it go and grabbing liquidity makes perfect sense. Now, obviously, if it then does this, and it then does this, and it doesn't grab the liquidity, and Max comes in and it turns back around, that's the markup now, isn't it? Because it didn't grab the liquidity, which means one of two things. Either the buyers are now crossing the spreads. That's the first thing it could mean. Or the sellers don't have anything left to offer, right? So either, and it's either or, isn't it? Either there's more heavy buyers or less supply. Whatever it is, whatever the outcome of that discussion is bullish. Whatever the outcome of that discussion is, it's going to be bullish. And that occasion took place in these two occasions here. They didn't get the liquidity, so that became this situation here, didn't it? And that became that situation. And they didn't get the liquidity here, so that became this situation. Those two trades aggressively marked up, didn't they? So in other words, when it doesn't get new liquidity, there's a bigger chance of it marking up. This is why the original discussion, if you remember ages and ages and ages ago, when I had the very, very, very original discussion with Paul about waiting for liquidity, you're going to miss out on the big markup trades. Because if you're always waiting for liquidity, you're going to miss the markup phase. And therefore, you're going to get all the trades that don't make a lot of money because you're still buying into the supply. But you're going to get all the big trades that are now marking up because you're getting in because of the failure to get the liquidity. So when we're getting liquidity, for example, on the gold, it could well mean that the top edge is now in place. So when I see this type of thing happening at a top edge, why did they need liquidity? There must be some real money sellers coming in now, right? So if there's real money sellers coming in at those higher prices, if I'm going to buy into this, phase, which I did, I've still got some longs on. I took some longs against a lean against around about 80 and a half. It's went up to 80. It's went up to 81.1 for what it's worth, six ticks of profit. And I've got to stop in at break even again. But I know because they went for liquidity here as opposed to the last trade where they didn't go for liquidity, that there is now more selling coming in, which probably means that this is the high of the gold market now. Probably means that, right? So there's a very good chance that this market is finished on the upside for the time being, which isn't a bad thing because we went from 72 to 83 for over $1,000 per contract. So one of the things that we start watching is the fact that that's probably the top edge of gold. We're probably ready to look for possible top edge reversals, and that's where we're at just now with this gold trade. It's not as difficult as you might think, guys. And again, it's all about not getting liquidity, isn't it? It's about that concept of not actually achieving the liquidity that you thought you were going to get, and therefore, as a result, there's a story. There's a story to be taken from that information, isn't there?